everyone, my name is Afreen Azmat and I welcome you all in today's session. So today is actually a very important video for all of you, and this video is indeed very special for all you bankers. Why? Because I am going to cover all modules A, B, C, D in this one video. So this video is very beneficial for your exams. Not only conceptual clarity, you will get some practice questions also, which helps you to clear your examination. Thank you so much, everyone. So just watch this video and enjoy. Today we are starting module D, right? IEFS. We have completed module C in the yesterday's session. So now in this class, we are starting with the module D, and module D is overview of the financial market. So in today's class, we are going to discuss about the financial market, the overview relating to the financial market. This is IEFS module D, unit 29. So let's start discussing what is the financial market. The very first thing is, what is financial market? So financial market is what? Financial market is a market where buyers and sellers, they actually trade in money, commodities, financial securities, foreign exchange derivative at low transaction cost and at a price which are determined by the forces of demand and supply, which is known as price discovery. So financial market is a very big concept. Financial market is a place where investors are investing in different type of commodities. This can be money, there can be more commodities, there can be financial market, shares, EFTs, indexes, forex, everything. So here you can just invest your money in different type of commodities, in different type of investment opportunities which are present, and this too at a very low transaction cost, and this should be at a price which is determined by the forces of demand and supply. Then it is known as what? Then it is known as the price discovery, right? Now if we talk about the segments of the financial market, so there are different type of, or there are different segments of the financial market. If we talk about the different segments of financial market, there are credit market, money market, debt market, foreign exchange market, capital markets, capital market, and insurance market. There are the mutual fund market. So these are all the segments of the financial market: credit market, money market, debt market, foreign exchange market. There is the derivative market, capital market, insurance market, mutual funds market. These are the different segments of the financial market. Clear? Now, if we talk about the money market, so we are discussing with some of the important, okay, thing. Halaki every market has its own chapter in module D, but I'm just giving you the overview in this chapter, right? First, if we talk about the money market, right? So, money market perform the crucial role of providing a conduit of equilibrium short-term demand. So, money market is what? Money market is a place where the short-term instruments are dealt. Any market where the short-term instruments are dealt. Now, what is the short-term instrument? Which is less than 1 year. Short-term instrument is what? Less than 1 year. So, if any instrument has the maturity period of less than 1 year, they are considered as the short-term instrument. And money market is that segment of financial market where the short-term instruments are dealt. Where what? These short-term instruments are dealt. Okay. Now, what are the different types of short-term instruments? So, there is a promissory note, there are treasury bill, commercial paper, certificate of deposit, repurchase agreement, and bankers acceptance. So these are the different short term instruments. These are the different short term instruments of the money market. Okay. So there are promissory note, there are treasury bill, there are commercial paper, there are certificate of deposit, there are repurchase agreement, and there are bankers acceptance. Clear? Now, next, if we talk about the next thing, debt market and the foreign exchange market. Debt market and the foreign exchange market. If we talk about the debt market consists of largely of government securities. They consist more of government securities, and to a smaller extent they actually include bonds. Okay, so in a large extent they actually include the government securities. To a smaller extent they actually includes the corporate bond. Okay, companies, they raise fund for a longer period of time. Okay, they are the companies which raise funds for a very long period of time, say 5 years to 10 years, and they issue the typical long-term debt instrument which are known as corporate bond. What are corporate bonds? When, for example, any company want to start any business or they want any investment, they just want to raise money from the public, and they raise money from the public in the form of corporate bonds. They just issue bonds in which the public is investing money, and for holding this bond till the maturity, the company is providing them a fixed rate of interest yearly, right? And after the maturity, they will get their invested amount. This is the corporate bonds. So debt market, there are larger amount of government securities, and to a smaller extent, there are some corporate bonds. Okay. Now next, if we talk about the foreign exchange market, if we talk about what foreign exchange market, so foreign exchange market, it is commonly known as the forex market, first of all, and it is a global marketplace where currencies are traded. It is a global marketplace where the currencies are traded. So foreign exchange market, commonly it is known as the foreign market. So it is a global marketplace where currencies are traded, right? Foreign exchange market consists of banks which are the authorized dealers. So for a normal bank, no, normal banks are not allowed in the foreign exchange market. Only the authorized dealers, customers, and the Reserve Bank of India, they are allowed in the foreign exchange market, right? Now, next is our derivative market. Now, what is a derivative market, or what is a derivative? First of all, a derivative is a financial instrument which don't have its own value. See, derivative are those financial instruments which don't have its own value. Their value is dependent on the underlying assets. So, whatever the assets which are associated with this derivative, the derivative derives its value from that asset. The normal type of underlying assets that are connected to a derivative is, for example, there are some ratings, interest rates, there are some commodity price, like there are silver, gold, petrol. So these are the different type of common underlying assets which are associated with a derivative, right? Now, they require no initial net investment. If we talk about the derivative, they requires no initial net investment or very initial net investments. Okay, these settled on a future date. Okay, and in India, if we talk about in India, the derivatives are permitted and regulated by different type of regulators. So there is no one regulator in the derivative market. There are different type of regulator in the derivative market, like there are Reserve Bank of India in the derivative market. There are the SEBI, Securities and Exchange Board of India, in the derivative layer. Yes or no? Everyone who is just watching this session, it's a request, just please like and share the video to the maximum you can. Everyone, whoever is watching this session, it's a request, guys, that please like and share the video to the maximum you can. Everyone. Okay, derivative. Now, next is the capital market and insurance market. Now, See, when we are talking about the money market, so money market, financial market, these two broad classification is very important. So there is a money market and there is a capital market, right? So money market is the market where the short-term instruments are dealt. Short-term instruments means who have the maturity period of less than 1 year. And capital market is a place where the long-term instruments are dealt. Okay. So long-term instruments are dealt in the capital market. Long-term instruments means those instruments which have the maturity period of more than 1 year. If long term instruments are there, so long term instruments are those instruments which have the maturity period of more than 1 year, right? So if we talk about the capital market, they are the market for long term equity and debt. Now in this market, if we talk about the capital funds, they comprises both equity and debt which are issued and traded. So if we talk about these capital market, these are the private placement, these are the sources of debt and equity, as well as there are organized market like the stock exchange. Now, second is the insurance market. Insurance, we have already studied in detail what are the insurance market. If you all remember that I have told you the complete chapter of insurance, right? So insurance market in India, first of all, the insurance industry is actually broadly classified into life insurance and non-life insurance business. So there is a life insurance business, there is a non-life insurance business. If we talk about early days, the life insurance business has been undertaken by the Life Insurance Corporation of India, which is LIC, which is still valid. And the non-life insurance companies, they were regulated by GIC, General Insurance Company. Okay, and currently there are two regulators. Okay, so there are only one regulator. That is the Insurance Regulatory and Development Authority of India. So in today's, or if we talk about the current time period, there is the Insurance Regulatory and Development Authority of India, who is the regulator of the insurance market. Clear? Now, next, if we talk about the mutual fund, now what is the mutual fund? So, mutual fund is actually a mechanism for pooling the resources by issuing unit to the investors and investing funds, right? So, mutual fund is what? Pooling the resources. Mutual fund is what? The pooling of the resources. Pooling of the resources for what? Okay, so mutual fund in is very simple. So there are the money investors. There are different type of investors. The money from these investors are collected by a fund manager, professional fund manager, and they uses their credibility and information and invest this money in different type of equity, capital market or money market shares. Okay, then they earn the return, and then return is distributed amongst this fund manager and different type of investor. This is known as the mutual fund. Mutual fund is just pooling together the money, right? So if we talk about the mutual fund is regulated by whom? So there are two regulatory bodies. SEBI, Securities and Exchange Board of India, they regulate the mutual fund, right? But if we talk about the self-regulatory bodies, so there is the Association of Mutual Fund of India, AMFI, Association of Mutual Fund of India, which actually regulates the mutual fund. So mutual fund is what? Mutual fund is a pooling of money which are regulated by the professional fund manager. Okay. If we talk about the mutual fund, it is a trust that collects money from the number of investor. That is known as the mutual fund. Clear? There are different functions of the financial market. If we talk about the different functions of the financial market, what are the different functions of the financial market? First of all, price determination is there. Second, there is a fund mobilization. Price determination means price is determined by the forces of demand and supply, which is also known as the price discovery. right? Fund mobilization means it actually facilitate the funds from the hand of investors to the issuers, right? So it help in the fund mobilization. It helps in the liquidity. Your money is not locked up for a very long period of time. These investments are very liquid. You can just sold it in one click, right? So this is very liquid in nature. If we talk about the risk sharing, yes, it involves the risk sharing, easy access. It helps in the reduction of the transaction cost and the capital information. So all are the function of the financial market, right? When we are talking about the price discovery, now price discovery is what? Price discovery, also referred to as the discovery mechanism or price discovery process, it is a very important aspects of all the financial market. So price discovery, it helps in the determination of the prices of asset through the interaction between the buyer and seller. So when buyers and seller, they are interacting with each other, okay? So the from the buyers and sellers interaction, okay, we determine the prices of the asset. Now, there are a number of factors which determine the level of price discovery. There are a number of factors which actually determine what the level of price discovery, and these are what? First of all, the supply and demand, attitude to risk, volatility, or available information or market mechanism. So these are the number of factors. There are the number of factors which determine the price discovery. Clear? So this is it. This is the complete chapter. Now let's talk about some of the important practice questions related to this chapter. First, which of the following is not a segment of financial market? Which of the following is not a segment of the financial market? Agriculture, commodities market, credit market, money market, or insurance market? Everyone, please answer this question. Everyone. Easy question, you can all answer this question. Everyone, which of the following is not a part of the financial market? Everyone, please answer this question. Everyone who is watching this session, just please like and share the video to the maximum you can. Okay, which of the following is not a segment of the financial market? If we talk about which of the following is not a segment of the financial market, credit, money, and insurance market, these are under the financial market. These are under what? These are under the financial market. Not a segment. Which of the following is not a segment of financial market? Yes, agriculture commodities market is not a segment of the financial market. So A is the correct answer. Everyone, A is the correct answer. Clear? Next, certificate of deposit are instrument in which of the following market? Certificate of deposits are the instrument in which of the following market? Okay. Money market, credit market, debt market, or derivative market? Everyone. Certificate of deposits are instrument in which of the following market? Certificate of deposit. Everyone. Certificate of deposit are instrument in which of the following market? Money market, credit market, debt market, or derivative market? So certificate of deposit, these are short-term instrument, means they have the maturity period of less than 1 year. So if they have the maturity period of less than 1 year, then this come under the money market. So A is the correct answer. Okay, this comes under the money market. So A is the correct answer. Clear? Next, if we talk about the state development loans are instrument in which of the following market? State development loans are the instrument in which of the following market? Money market, credit market, debt market, or derivative market? State development loans are instrument in which of the following market? Money market, credit market, debt market, or derivative market? State development loans. Everyone, please answer this question. So the correct answer is what? Yes, it is a part of the debt market. It is the part of what? Debt market. Okay. Last, which following functions are of the financial market? Capital formation, liquidity, price determination, or all of the above? Which of the following functions are of financial market? Which of the following functions are of financial market? Capital formation, liquidity, price determination, or all of the above? So the correct answer is yes, it is all of the above. There is a capital formation, there is liquidity, price determination for all of the above. The money market, okay? Money market, this is unit 30 of module D. Okay, so let's start discussing what is money market, what are the implications of the money market, and what are the important characteristics of money market, right? So let's start discussing first of all. If we talk about the money market is actually a place. Sorry, money market is actually a place where short-term funds are traded. Means any market where the trading is done in short-term instruments. When trading is done in what? Short-term instruments, okay, which have the maturity period of less than 1 year, then it is known as what? Then it is known as money market, okay. So money market is a place where, always remember, the trading is actually done on those investment instrument which have the maturity period of less than 1 year. Okay. Now, money market performs three important functions. First of all, let's discuss about the definition. It is a market for short-term funds with a maturity of overnight. Means you can have the maturity of overnight to 1 year, and these includes the financial instruments that are deemed to be close substitute to money. Okay. Now, money market perform three broad functions. If we talk about the money market, they perform three broad functions. First, if we talk about the equilibrium mechanism, they actually provides an equilibrium for demand and supply for the short-term funds. They enables borrowers and lenders of short-term funds to fulfill their borrowing and investments required at an efficient market clearing price. And last, provides an avenue for central bank intervention in influencing both quantum and cost of liquidity in the financial services. So it is very simple. So you can just say that money market is a place where short-term instruments are dealt. Okay, short-term instrument means which have the maturity period of less than 1 year. Okay. Now, if we talk about the next thing is there are different types of instrument in the money market. There are different type of the instrument, like we have the call money, we have notice money, and we have term money. Call money, notice money, and term money. Okay. The first thing is call money. Okay. So the call, notice, and term money. First of all, if we talk about these instrument, these are actually a instrument for very short term liquid financial assets, right? These are for very short term liquid financial assets that are readily convertible into cash at a low cost, that are easily convertible into cash at a very low cost. If we talk about the call money, term money, and notice money, first of all, if period of lending is 1 day. Okay. Basically, these are actually used by an institution, where an institution who has the surplus fund. If the institution they have the surplus fund, they may lend to those institutions who have the shortage of fund, and that too on a uncollateralized basis, and that too on a uncollateralized basis. Then the call money, term money, and notice money things are used. Okay. So when we are talking about period of lending, if it is a period of lending for 1 day, then it is known as call money. If it is between 2 to 14 days, then it is known as notice money. And if it is exceeding 14 days, If it is what? If it is exceeding 14 days and up to 1 year, then it is known as term money. So call, notice, and term money. Very simple. The institution, if they have the surplus fund, see, there are institutions who have what? Who have the surplus fund. They lend to those institutions who have the shortage of fund. They lend to those institutions who have what? Who have the shortage of fund. Okay, so if they lend overnight, okay, for 1 day, if they lend for 1 day, then it is known as call money. If they lend between 14 days, then this is known as test money. Then if they lend for more than 14 days, but the period of 1 year, then it is known as term money. Then it is known as what? Then it is known as term money. Simple, clear? Now, next thing. If we talk about the next thing, treasury bills. Now, what are treasury bills? Treasury bills are the money market instrument which are for the purpose of short-term application for Government of India. So, if Government of India want to carry out some activity in which they want the short-term fundings, right? Short-term borrowings, then these short-term borrowings are actually managed by the way of treasury bill. Treasury bills are those money market instruments which are actually offered for the purpose of financing the very short-term debt obligation of Government of India. There are three types of treasury bill important. So treasury bills are actually issued in three maturity period. So 91 days maturity period, 182 days maturity period, and 364 days. Okay. So treasury bills, they are issued for 91, 182, as well as 364 days time period. If we talk about the investment in these bills, it may the investors can be the person who are the resident of India, any person who is living in India, who has the citizenship of India, they can just invest their money in the treasury bill. Okay, this can include the state government, this can include any firm, company, corporate body, institution, trust, and retail investors. Okay. Now, NRI, overseas citizens of India, foreign portfolio investors, these are eligible to invest, but these are subject to the approval of central government and the provision of Foreign Exchange Management 1999. Okay, now settlement. If we talk about the treasury bill, it settles in T+1 basis. It means that if the transaction is done today, like for example, today is Thursday, so today is Friday. If the transaction is done on Friday, then it will be settled on Saturday, right? Working days. T+1 means transaction plus 1 day extra to settle the complete transaction. Okay. Now, settlement take place on T+1 basis. If the day of payment falls on a holiday, then the payment is made on the working day following the holiday, right? If we talk about the treasury bills and commercial uh, bills, then this is issued for a minimum amount of 10,000. They are issued for a minimum amount of 10,000 and then in a multiple of 10,000. This is very important. Okay, so treasury bills, first of all, if we talk about the treasury bill, they actually represent the very short-term debt obligation of the government. Now, treasury bills are issued in three different maturity time period: 91 days, 182 days, and 364 days. If we talk about the treasury bills are can investor can be any citizen of India. They can be NRI, overseas citizens also, but they should take the permission from the government and the FEM, right? Transaction is T+1 settlement days plus. If we talk about the treasury bill, they are issued for a minimum amount of rupees 10,000 and then they are issued in the multiple of 10,000. Okay. Now next, if we talk about the certificate of deposits and the commercial paper. Certificate of deposit, this is negotiable money market instrument which are issued in a dematerialized form. Dematerialized form means only in the electronic format, and these are issued by the scheduled commercial bank, which include the regional rural banks and small finance bank, and those financial institutions which are permitted by RBI to raise short-term resources. So if there is a bank and if there is a scheduled commercial bank or any financial institution which are permitted by Reserve Bank of India they want to raise money from the public, they can issue the certificate of deposit, which is a negotiable money market instrument, means they have the maturity period of less than 1 year, and they are only issued in the dematerialized form. If we talk about the certificate of deposit, they are issued at a discounted price and redeem at par. For example, the face value of this certificate of deposit is 100 rupees. For example, I'm just giving you it's a very simple example. They are issued at discount price, means you will get this certificate of deposit, for example, at 90 rupees. Okay, they are issued at discount, means you have purchased this at 90 rupees. Now it is sold at par value, means now it is sold at 100, whatever the value that is mentioned on that certificate of deposit. So you will get a profit of rupees. Okay, now the tenure of issue, it can range from 7 days to 1 year. The tenure of issue, it can range from 7 days to 1 year. Now, the minimum amount of a certificate of deposit is 5 lakh, and it is in the multiple of 5 lakh. The minimum amount of certificate of deposit is 5 lakh, and it is in the multiple of 5 lakhs. Now, next is the commercial paper. If we talk about the commercial paper, it is an unsecured money market instrument. Commercial paper is what? Unsecured money market instrument, which is issued in the form of promissory note. It is simply issued in the form of a promissory note. Who are the issuers in the commercial paper? So whoever are the eligible participant or who are permitted to issue this commercial paper, they shall obtain a credit rating first of all for the issuance of the commercial paper, and this credit rating should be from any of the credit rating agencies which is SEBI approved, right? Now the minimum rating is, it should be A3, and it should be defined as per the prescription of Securities and Exchange Board of India. The time period, the minimum time period for the issuing of commercial paper is 7 days, and it is issued for a period of 1 year maximum. It is issued for a maximum period of 1 year. Clear? Now, next. Okay, so this is it. This is a very short chapter, I guess. Yes, this is a very simple, this is a very short chapter for all of you, right? So now I'm just giving you a thing that if you want to study the complete topic, I've just covered up the most important thing related to this chapter. Okay, I've just covered the most important thing that is related to this chapter. Now, if you want to study the complete chapter, so this is IEFS module D, and the name is pension products. So this is unit 43. So let's start discussing about this chapter, pension products. Okay, first of all, what is a pension? So if we talk about the pension provides a monthly income to the people during their unproductive years, means when they have left job, now they are not doing anything, right? So pension is a way to support people at the old age, right? So because of the old age, and because now they are not working during their all unproductive years, pension actually provide a monthly income to the people, right? And pension is necessary for which of the following reason? Yes, pension is necessary for the reasons like decreased income earning potential with increase in age. Okay, so obviously you know that when your age is increasing, you have a potential that your income will be decreased. It is not in every case, but yes, more potential is that the income will be decreased, right? So this decreasing potential generates insecurity among the older people, plus all the mental stress they have. So to reduce that, pension is very necessary. Pension is necessary for because of the nuclear families. Nowadays, everyone is living in a nuclear family. Hardly there is one or two who is living in a joint families. Pension gives you what? Pensions give you a monthly support. Okay, then there is a migration of earning members. So if the earning member is moving abroad, right, and when they are moving to another
city, or this they are leaving their parents, then obviously a pension helps the older person to manage their own expenses. Because of the rising inflation, you know that there is a lot of rising inflation right now. There are a lot of inflation currently right now, right? So for these rising inflation, okay, for managing these rising inflation, pension is a way to support everyone, okay. Increased longevity, okay, and life is dignified life in the old age due to the financial dependence. So for all these purposes, pension is very necessary. So pension in a way actually provides you what? Pension is a way actually to provides the monthly support to each and every one, right? Next, if we talk about the pension products, so pension product, first of all, there are two stages in the pension product. What are these two stages? There is an accumulation stage in the pension product and there is a vesting age in the pension product. Accumulation stage means when one pays a specific amount regularly until the person's retirement. So until the person's retirement, when one pays a regular amount and save a regular amount, then it is known as the accumulation stage. Now, what is vesting stage? Vesting stage, when the individual retires, then he will get a steady flow of income for the rest of the life. So, accumulation, you are saving the regular amount till the age of your retirement, and after the retirement, then there is a vesting stage. Vesting stage means he gets a ready, steady flow of income for the rest of the life. Now, if we talk about the pension product must perform these five core functions. Okay, so there are five core functions in the pension product. First, the reliable collection of contribution, taxes, and other receipts. Okay, then the payment of benefits. Okay, third, it helps in securing your financial management. It helps in maintaining an effective communication network. And last, there is a production of financial statements and reports. Okay, so these five core functions should be performed by any pension product. So if you are launching or if you are planning to launch any particular pension product, you should be seeing that these are the five things, these are the five functions that should be involved in the pension product. And now what are the five things? First of all, there should be a reliable collection of contribution like taxes and other receipt. Then you have to pay the benefits, okay, timely and in the correct way. Not only you have to pay the benefit, you have to pay the benefit timely, because this is the very important thing, very important core of the pension product. Then securing the financial management, then maintaining an effective communication networks, and last, then to produce the financial statements and report. Clear? Now, if we talk about the different type of schemes of the pension product, so yes, there are different type of schemes in the pension product. Like there is an employee provident fund scheme, EPF. There is provident fund scheme, PPF. There is insurance annuity scheme, there is national pension scheme, and there is Atal pension yojana. So these are the five different type of schemes which we are seeing in the pension products. Now let's start with the employee provident fund scheme. Employee provident fund scheme, okay, this is the mandatory scheme for the private sector. So what about this scheme? This scheme is actually a mandatory scheme for the private sector, and it is managed by the Employee Provident Fund Organization, EPO. EPFO. So very important. See, from here you can get various type of question, right? Like employee provident fund scheme is managed by which organization? So employee provident fund scheme is managed by the employees provident fund organization, and this scheme is mandatory for the private sector. It was set up in 1952. The scheme was actually set up in 1952, and it actually covers all those employers which have 20 or more than 20 employees, right? Or more than 20 employees. So if you have more than 20 employees, then you should be covering, or there should be an employee provident fund scheme. Now, it is a statutory body under the Ministry of Labour, Government of India, which is responsible for regulation and management of provident funds in India. Now, EPFO, they operate three major schemes. So, there are three major schemes in EPFO, Employee Provident Fund Scheme. First is Employee Pension Scheme. Second is Employee Deposit Link Insurance Scheme. And third is Employees Fund Scheme. These are the three major schemes which are operating with the EPFO, Employee Provident Fund Organization. Now, employee provident fund organizations functioning include these functions. So, there is an provident fund organization. So, which of the followings are the functions of the employee provident fund? So, first of all, it help in the enforcement of this act across the country. So, this act should be implemented in the complete country. So this should be enforced by EPFO, Employee Provident Fund Organization. Maintenance of the individual account, you have to maintain the individual account. Settlement of the claims, you have to settle the claim. Investments of the fund and ensuring prompt pension payments and updating records. So these are the functions of the EPFO, Employee Provident Fund Organization. You should ensure that there should be an enforcement of act across the country. You should maintain maintenance of the individual account, settlement of the claims, investments of the fund, ensuring prompt pension payment and updating records. So these are the employee provident fund organization. Clear? Now, next, if we talk about the Employee Provident Fund Organization that introduced the Universal Account Number. Okay, UAN, Universal Account Number, which act as an umbrella for multiple member ID allotted to an individual by different employers. So, there are different employers, but there is a universal account number UAN which is allotted by employee provident fund organization, which is actually an umbrella ID for every employee, right? So for example, I am an employee, so I have a universal account number which is given to me by EPFO, and that is same for every employer. It means that when I'm changing the organization, when I am changing the job, my EPFO will remain, my universal account number will remain the same. Now, universal account number is a 12-digit number which is assigned by the Employee Provident Fund Organization. Now, if we talk about UAN enables the link of multiple EPS account allocated to a single number. Universal account number program was launched in October 2014 as a part of Pandit Deen Dayal Upadhyay Shram Jayate Karyakram, right? Now, the total employer's contribution is 12% of the employee's basic salary plus earnings allowances. And under this, there should be an employee provident fund and employee pensions scheme, EPS and EPF. So EPF 3.67% of the basic salary plus the dearness allowances. Okay, and EPS provides a pension to the employees after retirement, which includes benefit for employees who become disabled or dependent or they're dependent in the case of death, right? So EPS and EPF, these are the two contributions. So total employer contribution is 12%, in which EPF towards EPF is 3.67 of the basic salary plus the dearness allowances, and EPS is 8.33% of the basic salary plus the dearness allowances. But in the employee pension scheme, it is the maximum contribution can be up to 15,000, not more than that. Now, what is the benefit of EPF? The benefit is the high interest. You will earn high interest. Okay, exemptions from taxes. So you will get exemptions from taxes. This is low risk life insurance and you will have a hassle free life, right? So this is the employee provident fund scheme. Okay, so I have just given a very short overview of the important topic related to this chapter. I have not covered the complete syllabus. Okay, now let's talk about some of the practice questions related with this chapter. Okay, so first is question is pension product generally have two stages, the accumulation stage and discharge, pension vesting or banking stage. So pension product has two stages. So let's talk about the pension product. What are the two stages of the pension product? Accumulation stage and, everyone please answer this question, accumulation stage and what? Everyone please answer this question. Accumulation stage and what? Pension product generally have two stages. Accumulation stage and, everyone, discharge stage. pension stage, vesting stage, or a backing stage? So the correct answer for this question is what? Yes, so the correct answer is yes, vesting stage, accumulation stage and vesting stage. So these are the two stages of the pension product, right? So what is the lock-in period for PPF account? Sorry, what is the locking period of PPF account? Everyone, please answer this question. Locking period of PPF account. Everyone, please answer this question. So, if we talk about the locking period, it is 15 years. Yes, the locking period is 15 years. Next, what is the minimum age to join a person, or what is the minimum age for a person to join in the Atal Pension Yojana? So, for if you are enrolling yourself in the Atal Pension Yojana, what is the minimum age to join in that Yojana? Everyone, please answer this question. What is the minimum age to join in that yojana? Everyone, you can all answer this question. Just please answer this question, everyone. It's very easy. You can all answer this question. It's very easy. You can all answer this question, guys. Yeah. So yes, it is 18 years. 18 years is the minimum age to which you can join in the Atal Pension Yojana. Okay. We have only one class left. We have only one class left. That is Unit 45, and we are set. We have completed the whole syllabus of IEFS. So let's start this para banking and financial services which are provided by the bank. First of all, let's talk about what is para banking or financial services. Para banking means what? Para banking means all those activities which are carried out by the bank other than their normal day-to-day activities. So for a bank, the normal day-to-day activities is like they have to deposit, they have to withdraw, okay, they have to give loan, they have to invest, right? So these are the normal day-to-day activities of the bank. There are some services which are other than this also. There are some services which are other than normal day-to-day activities of a bank, okay, and these are known as para banking and financial services. So Reserve Bank of India has added a different type of services for the bank as their para banking and financial services. Like if we talk about the investment advisory services, the agency business, okay, broking, insurance for commodities, okay, so these are all the different type of financial activities which are added to the parent banking services of a bank, right? Now, if we talk about the activities of the bank, so activities of the bank includes what? Activities of the bank includes like sponsoring. If a bank is sponsoring an infrastructure debt fund, then it is a para banking services. Equipment lease and hire purchase, it is para banking services. Factoring services, it is a para banking services. Primary dealership business, it is a para banking services. Underwriting activities, again a para banking services. Mutual fund business, etc. So these all comes under the scope of para banking and financial services, which has been given by whom? Which has been given by the banks, right? Now, if we talk about the general guidelines, okay, so what are the general guidelines or what are the general instruction that has been given to a bank for carrying out this para banking and financial services? So first guideline is bank can undertake the permitted business. Permitted business means whichever is permitted by Reserve Bank of India. So bank can undertake the permitted business which has been carried out by the Reserve Bank of India under Section 6(1) of the Banking Regulation Act 1949, and they can do so either by opening a different department under the bank or by having a separate subsidiaries, right? Next, if we talk about an activity undertaken departmentally shall also follow Reserve Bank of India's guideline. They have to complete the KYC compliance and charter on customer rights, right? Bank are also allowed to hold that they can hold equities and both financial as well as companies which are not engaged in the financial services activities within a limit, right? So bank are all allowed that they can have the general guidelines. They have they can have a general procedures, okay, and they just follow these all general guidelines for just investing or for carrying out some para banking services. First of all, they can do it either departmentally or through a different subsidiary. They can undertake departmentally. If they want to take an activity by opening a different department, they should follow RBI's whole guideline, KYC compliance, and all the Charter of Customer Rights. These should be what issued. Then bank are also allowed that they can hold equities in both financial service companies as well as companies which are not engaged in the financial activities, right? But they can, the limits they have, there are been certain limits that has been specified under section 1912 of the Banking Regulation Act 1949. So under that limit they are allowed to hold the financial services activities or equities in all in the companies who have the financial service companies and who don't have the financial services companies, right? Next, if we talk about the prudential regulations for banks' investment in a subsidiary or in a financial service company, prudential regulation for banks' investments in a subsidiary or in a financial service company. First of all, the limit of investment. Limit of investment. First, equity investment in a subsidiary company or a financial service company not being a subsidiary individually shall not exceed 10% of the bank's paid up capitals and reserve as per the last audited balance sheet. So if we talk about the prudential regulations, if the bank want to invest in a subsidiary or in a financial service company, first of all, if you want to do an equity investment in a subsidiary company, equity investment in a subsidiary company or any financial service company, not being a subsidiary, that is not your subsidiary, okay, and you want to do it individually, the equity investment shall not exceed 10% of the paid up shares capital and reserve. It cannot exceed 10% of the bank paid up share capital and reserve, and this is as per the last audited balance sheet, whichever is lower. Okay. Second, the aggregate of the equity investment in factoring subsidiaries and in factoring companies shall not exceed 10% of the bank's paid up capitals and reserve. Okay, so if you are investing in a equity investment, okay, the aggregate of the equity investment in factoring subsidy and factoring company, it shall not exceed 10% of the bank paid up capital and reserve. Bank shall not contribute more than 49% of the equity of infrastructure debt fund, IDF, okay, as a non-banking finance company, which is IDF NBFC. So if you want to invest in the IDF NBFC infrastructure debt fund, non-banking finance company, bank shall not contribute more than 49% of the equity. Okay, a bank contributing less than 30% of the equity in IDF NBFC shall not be a sponsor. So, first of all, there is a limit that you cannot exceed 49% of the equity of infrastructure in the NBFC IDF, right? And if your investment is even less than 30%, if your investment is even less than 30% in the equity of IDF and BFC, you shall not called as a sponsor of that company. Clear? Okay, if we talk about the limit of investments, okay, so yes, there are certain limits on the investment, there are certain limits on the infrastructure. First of all, bank are not allowed to hold more than 10% of the equity in a deposit taking NBFC. So, if you are want to invest in the deposit taking non-banking financial company other than a housing finance company, you are not required, you are not allowed to hold more than 10% in the equity of the deposit taking non-banking financial company, right? Further, bank should not invest more than 10% of the unit capital of the REITs, Real Estate Investment Trust, and Infrastructure Investment Trust. So, bank further, these should not invest more than 10% of the unit capital of the REITs as well as InvITs. Third, besides, banks should not hold more than 10% of the paid up capital of a company. Bank should not hold more than 10% of the paid up capital of that company, not being its subsidiary, engage in a non-financial services, or 10% of the bank paid up capital or reserve, whichever is lower. So if the bank want to hold more than 10% of the paid up capital of the company, not being the subsidiary or in the non-financial services, it can be 10% of the bank paid up capital and reserve, whichever is lower. However, if the investment is in excess of 10% and not exceeding 30% of such investee company, the investee company can engage in non-financial activities which are permitted for the bank under the section 6(1) of the Banking Regulation Act. So these are the limits on the investment for the banks, right? So if a bank want to invest in equities of the companies, right, they can invest, but these are the certain limits which has been classified, that it cannot invest more than 10%, more than 20%, it cannot hold more than 10%, in excess of 10%, not exceeding 30%, etc. So these are all the limits on the investments. Clear? Now, relationship with a subsidiary. Okay, so if you want to have a relationship, so if you have invested in a particular company, this company is a subsidiary, right? So you have to maintain some kind of instruction and rules and regulations with that subsidiary. So first of all, a parent or a sponsor bank, whoever has invested in that subsidiary, should maintain an arm length relationship with that subsidiary. Means you should give space to that company for working and function. You cannot engage yourself so much in that company that that company don't have their own space to work, right? So you should be giving an arm length relationship or arm length distance to that subsidiary company. First of all, the board of the directors of the parents or sponsor bank shall review the working of subsidiaries at a periodic interval. So there are board of directors of the parents or sponsor bank, and they review the working of subsidiaries at a periodic interval. The parent sponsor bank shall undertake inspection, audit of the books of the account of subsidiaries at periodic interval. Okay, so at periodic interval, you should take inspection and audit of the book of the accounts. The subsidiary shall not set up another subsidiary. So if that subsidiary is of you, they cannot allow to have set up another subsidiary, or they cannot promote any new company, okay, without the permission of Reserve Bank of India. Last, the subsidiary shall not make any portfolio investment in any other existing company with the intention, but this should be with the intention of acquiring control interest, okay, and it cannot be done without the prior approval of Reserve Bank of India. Okay, so this is the kind of relationship a sponsor bank has to maintain with the subsidiary companies, right? So subsidiary companies shall not make any portfolio investments. Okay, they shall not allow to hold another subsidiary. You should be maintaining an arm length relationship. You should be taking an inspection or audit of the book of accounts at periodic interval. The board of directors shall review the working of the subsidiaries at periodic intervals. So these are the relationship with the subsidiaries. Clear? Now, para banking and financial services which are taken by the bank. So there are different type of para banking and financial services which has been undertaken by the bank. Now let's talk about some of the para banking and financial services. Some of the para banking and financial services that has been undertaken by the bank other than their normal course of business. So para banking is that services which a bank is undertaking other than their normal course of business, right? So if we talk about the para banking and financial services which is undertaken by the bank, first of all, sponsoring of an infrastructure debt fund. Sponsoring of what? Sponsoring of the infrastructure debt fund. So infrastructure debt fund, it can be set up either as a mutual fund IDF or a non-banking finance company. So debt fund infrastructure debt fund, it can be set up as a mutual fund also, and it can be set up as a NBFC. means non-banking finance company also, right? Now, if we talk about the uh, approval, so you have to take before the investment, you have to take board approval after making a proper disclosure in the prospectus or documents, right? Second, equipment leasing and hire purchase business. Okay, so equipment leasing and hire purchase business, that can form of subsidiary companies for undertaking equipment leasing and hire purchase with prior approval of Reserve Bank of India. Okay, so bank can form what? Bank can form a subsidiary company, and it can be for undertaking equipment leasing and hire purchase, and it with period means you have to take first permission from Reserve Bank of India, then you can take this business, right? But this business cannot be taken as a department, right? You have to form a subsidiary. This business cannot be taken as a departmental business. You have to form a subsidiary company for that. Clear? Third, factoring services. Factoring. So the process of factoring, factor is what, how the factoring take place. We have already discussed in complete detail. What is factoring, right? So factoring is an arrangement for finance of company against invoices. So whatever the invoices, the bill of exchange, the company has raised on its buyer, against that, if they want to have immediate credit, then the factoring can help. Factoring is an arrangement for the finance company against the bill that is raised on its buyer. Now, this factoring can be done with recourse and without recourse also. But in India, without recourse is not permitted. And the bank is allowed that they can take the business of factoring services also. It is one of the very important parabanking services to which the bank is giving, because any institution which are coming for the loan, they are giving credit on the basis of the invoices, that is factoring by the right. Now, primary dealership business. Okay, so primary dealership business is what? First of all, for undertaking the primary dealership business through a subsidiary, a bank should be registered as NBFC with the Reserve Bank of India, DNBR, right? So first of all, if you want to take this business, primary dealership business, okay, you can take it through a subsidiary. It cannot be done through a department. You can be taking it as a subsidiary, right? And you have to register as NBFC with the Reserve Bank of India for taking this primary dealership business. Okay. Now, if you want to take the primary dealership business departmentally, sorry, subsidiary and departmentally both, you can take this business both. Okay. The bank has to register with Reserve Bank of India IDMD for the same. So, if you want to take this business as a subsidiary, you want to be registered as NBFC with RBI. If you want to take this business as what? As the departments, then you have to register with Reserve Bank of India IDMD for the same. Now, what is a primary dealer? A primary dealer is a RBI registered entity who are authorized in buying and selling of the government securities. So, if you are authorized by Reserve Bank of India for the buying and selling of the government securities, then you are known as a primary dealer. There are two type of primary dealers in India. There are standalone primary dealers and there are bank primary dealers. Standalone and bank primary dealers. Standalone primary dealers, they are subsidiaries of a scheduled commercial bank. The permitted structure of a primary dealership, you have to follow this certain criteria. First of all, your minimum net owned fund should be 1000 crore. Your minimum net owned fund should be 1000 crore. Your minimum cash reserve average risk ratio should be 9%, and net non-performing assets should be less than 3%, and the profit making record for the last 3 years, right? So these are the primary dealerships, right? Standalone primary dealers. Okay, so there are primary dealers which are registered, RBI registered entity, which are authorized in both buying and selling of the government securities. Clear? Now, Next is the underwriting activities. Yes, bank can also take this business of underwriting, right? Underwriting helps you in the issue of shares and debentures and bonds, okay? And bank can take this business either departmentally or through a merchant banking subsidiary, right? Bank are extended or permitted to extend the underwriting activities for the corporate shares, debentures, and public sector bonds as a part of para banking activities. So if the bank want to have a underwriting activity, okay, so they can do the underwriting. They can help the corporate in raising their shares, okay, and debentures and public sector's unit undertaking spot, okay, as a part of the banking activity. Mutual fund business, again, bank are also allowed to take the mutual fund business, okay, but this should have the approval of Reserve Bank of India. So first you have to take the approval of Reserve Bank of India, okay, and then as a bank you can start this business, mutual fund business, right? So if a bank is sponsoring any mutual fund, it should be according to the whole guidelines which are issued by the SEBI, Securities and Exchange Board of India, okay. And when there is any particular bank name which is associated with the mutual fund, a suitable disclaimer clause should be inserted while publicizing the new scheme, that bank is not liable or responsible for any loss or shortfall resulting from the operation of that scheme. So if you are promoting any mutual fund as a bank, or if your name is associated with any mutual fund, there should be a proper disclaimer before publicizing this scheme that the bank is not responsible for any type of loss and shortfall resulting from the operation of that scheme, okay. And bank should only act as an agent of the customer, okay. So they just act as an intermediary. They just try to meet the customer with the platform, okay. So they should act only as an agent, okay. They should be forwarding the investor's application for the purchase and sale of mutual fund to the registered agent, okay. They are not responsible for anything else, okay. So these are the certain type of para banking and financial services which has been undertaken by the bank. REITs and InvITs, which is unit 45. First of all, what are REITs? So REITs is actually an another way to get investment in the real estate. So if you want to get investment, or if you want to invest in the real estate, okay, then you can just invest in the equities or stock of the listed real estate companies, right? So in this REIT are the investment vehicle where the money are actually pooled from the investors. So there are different investors, okay, and these investors just sum up and pool the money like in the mutual funds, and then this money has been utilized by portfolio in the real estate assets, okay. So these are what the money are pooled, and then the money are used to buy portfolios in the real estate assets, okay. They manage these assets to generate a regular income and capital appreciation. In order that to ensure that the REITs is able to generate income, 80% of the profile of the REIT are actually invested in the completed and rent generated properties, right? While REIT can invest in all kind of income generated properties such as residence and offices and hotels and malls and warehouses in India, REITs are mainly focusing on the office space, okay. So money are actually pooled together in the REITs and then actually invested to buy the real estate property or assets, okay. So you are actually the fractional owner of that real estate property, then it is known as REITs, right? And in order to ensure that the REIT holder should get a proper and regular income, 80% of the investment of the REITs are actually invested in the income generated properties, like they are invested in the residences and offices and hotels and warehouses, etc. Right? Next, if we talk about the history of REITs, what is the history of REITs? Okay, so history of REITs is structured on the line of mutual fund and were first introduced in USA in 1960s, right? So REITs, for the very first time, REIT has been introduced in USA in 1960s. Next, if we talk about the REITs, REIT was first introduced by SEBI, Securities and Exchange Board of India, in year 2007, which is almost 50 years after they were first incorporated as the investment vehicle. So the very first time REIT were introduced in India, it was by the Securities and Exchange Board of India, and it was in year 2000, okay, which is almost 50 years after they was first incorporated as the investment vehicle. If we talk about the first Indian REITs, these were established in 2017, and the name of this REIT was Embassy REIT. The name was this REITs was Embassy REIT, and it is open for initial public offering in March 2018. Then, if we talk about the REIT companies are listed in the Indian Stock Exchange, like National Stock Exchange and Bombay Stock Exchange, and these are monitored and regulated regularly by SEBI, Securities and Exchange Board of India, in order to ensure the adherence to the industry's practices by REITs and safeguard the interest of the investor. So, for safeguarding the investors, interest of the investors, and for ensuring that the REITs should have a proper and without any fraud, the industry is practicing goods, then the REITs are listed in the Indian Stock Exchange. These are monitored and these are regulated by the Securities and Exchange Board of India. So first, if we talk about the REITs introduced in USA, in India it has been introduced in 2017. The first REIT was Embassy REIT, regulated by SEBI, Securities and Exchange Board of India. Clear? Now next, if we talk about the organizational structure of the REITs, what is the organizational structure of the REITs? So REITs are very similar to mutual funds. REITs are what? REITs are actually very similar to mutual fund. Why? Because they allow the pooling of money. It's just as same in the mutual fund. So as in the mutual fund, the pooling of money is there. So in the same REIT structure, the pooling of money is there. And in both mutual funds and REITs, the money are actually managed professionally by a designated fund manager. So there is a designated fund manager which is actually doing what? Which is actually managing the money of the investor. Okay. Now, here, if we talk about the mutual fund, the underlying of the mutual fund can be any equity, debt, gold, or combination of these. Whereas in REIT, it is actually the physical property, right? Now, when we are talking about the REITs actually, when the real estate company, they decide to form a trust, they become the sponsor of the REITs and they appoint a trustee. The very first step is when there is a real estate company, okay, and that real estate company want to be a REIT, right? Want to be form a REIT, real estate investment trust. Then they just first of all become the sponsor of that REIT, and then they appoint a particular trustee. Then they do what? Then they appoint a particular trustee. Now, trustee holds the real estate asset. The trustee holds the real estate asset of the trust in their trusteeships, right? And these are no longer directly controlled by the sponsor. Then the REIT may control its real estate holdings either directly or through a formation of a special purpose vehicle. So, first of all, there is a trustee. Okay, now the trustee hold the real estate assets, and now these are no longer directly assets by the sponsor. Now, then this REIT may have a special purpose vehicle which actually control the real estate holding, and it can be directly or it can be indirectly. Clear? Now, a special purpose vehicle is a actually domestic company which hold real estate assets on the behalf of REIT. Okay, and as per the regulation, the trust must hold 50% equity in the special purpose vehicle. So the trust must have a 50% equity in what special purpose vehicle. Now, the trustee, it appoints a manager to manage the real estate property and to take the investment decision. After the manager has been appointed, the REIT can be registered, and once registered, the REIT can raise the money from the public by the sale of units, and it can be done either publicly on stock market or through the private placements, right? At the most basic level, REITs unit represent the part ownership of the real estate held by the trust, and this entity is the unit holder of the share of the income generated REITs. So you become actually the fractional owner of that property, and you will be getting income depending upon how much unit of the REITs you are holding. Okay, so this is actually the organizational structure of the REIT. Okay, so REIT appoints a trustee. Now, when trustee is appointed, then it is longer controlled by the sponsor. Then there is a special purpose vehicle which is managing the REITs, right? Special purpose vehicle is a domestic company, and the trustee should have a 50% holding in the special purpose vehicle. Now, the trustee appoints the manager to manage the REIT and to take the investment decision. After the manager is appointed, the REITs can be registered, right? At the most basic level, the REIT represent a fractional ownership of that property. Clear? Now, there are typically different type of REITs which are mentioned here. So there are different type of REITs, like there are retail REITs, there are residential REITs, there are healthcare REITs, there are office REITs, there are mortgage REITs. So these are the different type of REITs which has been introduced. Okay, and retail, residential, healthcare, office, and mortgage REITs. Okay, now we will be discussing these REITs in detail in the batches itself. Okay, now this second part of this chapter, which is known as InvITs. Now, what is InvITs? InvITs are actually innovative trust-based financial instrument which enables the participation of the investors in the infrastructure financing. So if you want to do infrastructure financing, if you as an investor you want to invest in the financing of any infrastructure, then InvITs, these are the financial instrument, innovative financial instrument which enables you participate in the infrastructure financing, right? So InvITs therefore provides opportunity invest in the infrastructure asset, okay, with predictable cash flows and dividend. Once we are talking about the InvITs had been introduced in India in 2014, and these are employed by infrastructure assets owner. So InvITs, this has been introduced in what 2014, and these are employed by infrastructure assets owner to pool money from a diverse set of investor against the payout of the cash flow income generated by the asset. Now, if we talk about the InvITs, these are established as the trust under the Indian Trust Act 1882. These are regulated and registered with SEBI, Securities and Exchange Board of India, Regulations 2014 and 16. While there is no hard and fast rule what is infrastructure, but there are certain sectors which are under the category of the infrastructure, like if you are participating in the road, port, power, railways, airport, telecommunication, energy, and coal and petroleum, cement production. So these are all actually the part of the infrastructure. These are all actually the part of infrastructure. Clear? Now, if we talk about the organization of InvITs, now how the InvITs are managed. So, InvITs are actually managed by three-tier managing structure. There is a sponsor, there is a manager, and there is a trustee. There is one sponsor, there is one manager, there is one trustee. If we talk about the sponsor, an invest can have a maximum of three sponsors. Usually, a sponsor is an infrastructure development company that originally built, owned, and operate the infrastructure assets of the trust. In which sponsors are mandatorily required to hold at least 50%, 15% stake in the trust for at least 3 years. Then there is a manager. Investments are managed by two type of manager. There is an investment manager and a project manager. Investment manager is ensuring is actually responsible for ensuring that the existing investment of the invest should provide returns as per their expectation. Whereas investment managers make new investments decision on the behalf of the trust to ensure the growth of the invest. Right? And there is a trustee. The key responsibility of the trustee is to hold the assets, okay, in trusteeship or to safeguard the what interest of the unit holder. So if we talk about the invets have a sponsor, these have manager. Manager means investment manager and a project manager, and there is a trustee. Okay, so these are the organization of invest.